What if I told you that staying in Canada until April 2026 could quietly wipe out your savings, crush your income, and leave you with tax bills you never saw coming? According to recent government projections and policy updates, the average Canadian household is already paying thousands more in hidden taxes than just 5 years ago. And the next wave is set to hit even harder. This isn't about the rich. This isn't about corporations. This is about regular people who work, save, and believe they're doing everything right. Here's the scary part. Most Canadians have no idea what's coming. New tax rules are being introduced slowly, quietly, and legally. They don't arrive with warnings. They don't knock on your door. They show up when you sell your home, touch your savings, retire, or try to leave the country. And by then, it's already too late. One wrong move could trigger penalties, audits, or permanent financial loss. In this video, I'll break down 10 new tax laws that could bankrupt you before April 2026, and what you can still do right now to protect yourself. Watch till the end, because knowing this could save everything you've worked for. Number 1, capital gains shock. One of the biggest financial changes coming before April 2026 is the expansion of the capital gains tax rules. On paper, it sounds simple. When you sell an asset like property, stocks, or a business, a portion of your profit becomes taxable. But the new inclusion rate increase means a larger percentage of that profit is now exposed to tax. That means if you sell a rental property, investment portfolio, or even a small business, you could lose far more than you expected. For many middle-class Canadians, this could mean tens of thousands of dollars gone overnight. What makes this more dangerous is that it doesn't feel like a tax hike at first. You might think you made a smart investment decision. You might believe you're cashing out at the right time. But once the higher taxable portion kicks in, your real profit shrinks fast. Retirees planning to sell assets to fund retirement are especially vulnerable. So are entrepreneurs who've spent decades building their companies. If you're considering selling major assets, timing matters more than ever. Speak to a qualified tax professional, review your numbers carefully, and calculate the difference before and after 2026 rules apply. One decision could change your entire financial future. If this information surprised you, tell me in the comments. Did you know about this change? We spend hours researching and breaking this down so you don't have to. So please support the channel by subscribing. It's just one click, but it helps us protect more people. Number 2, home tax trap. For decades, Canadians believed their primary residence was untouchable. Buy a home, live in it, sell it later, and keep the profit. But that sense of safety is fading fast. New reporting and compliance rules around the principal residence exemption are turning ordinary homeowners into accidental lawbreakers. Today, even a simple mistake, like failing to report the sale properly or misunderstanding residency timelines, can trigger automatic penalties, audits, and massive tax bills. Here's where it gets dangerous. Many people assume that because their home is tax-free, they don't need to worry about paperwork. That assumption is now costly. The CRA requires strict documentation, precise timelines, and formal declarations. Miss one form, file it late, or misunderstand what qualifies as a primary residence, and suddenly your tax-free home becomes a taxable asset. Seniors downsizing, immigrants with property history abroad, and families who rented out part of their home are especially at risk. What makes this worse is that penalties apply even if you didn't know the rule. The system doesn't ask what you intended. It only checks whether you complied. Many homeowners are discovering these problems years later, when it's too late to fix them. The profit they counted on for retirement or debt freedom gets eaten away by taxes, interest, and fines. The smart move now is preparation. Keep detailed records, understand your residency status, and never assume exemptions apply automatically. One overlooked detail could cost you everything you built through decades of work. Did this hit close to home? Drop a comment and tell us if you own a home or plan to sell one soon. We put serious time and research into these videos, so please subscribe to support the channel. It's just one click, but it helps us keep protecting you. Number 3, carbon cost explosion. Most Canadians think the carbon tax is just about fuel. A few extra dollars at the pump. Maybe higher heating bills in winter. But the real impact is far bigger, and far more dangerous. Every time the carbon tax increases, it quietly raises the cost of everything you buy. Food, deliveries, construction, electricity, even basic services all become more expensive because businesses pass those costs directly to you. What makes this terrifying is how invisible it feels. Prices don't jump all at once. They creep up slowly, month after month, until your paycheck suddenly feels smaller even though your income hasn't changed. Government rebates sound comforting, but for most families, they don't come close to covering the true cost increase. The difference is quietly pulled from your savings, your retirement plans, and your ability to stay financially stable. Low and middle-income households are hit the hardest. If you live in a colder region, rely on a car for work, or rent in a city where landlords raise prices yearly, the pressure multiplies. This isn't just inflation. It's a permanent cost structure change. Once these taxes rise, they almost never come back down. The smartest defense right now is awareness and planning. Track your real monthly expenses, not just your bills. Look at where energy costs hide inside groceries and services. Small adjustments today, like reducing high-energy consumption or renegotiating expenses, can slow the financial bleeding before it becomes overwhelming. Be honest in the comments. Have you felt your monthly costs creeping up without knowing why? We put countless hours into breaking down these hidden impacts, so please support the channel by subscribing. It's just one click, but it helps us keep exposing what others don't. Number 4, digital income crackdown. If you earn money online, even a little, you're now on the CRA's radar. The digital economy tax rules are tightening fast, and many Canadians don't realize how exposed they already are. Income from YouTube, TikTok, Instagram, freelancing platforms, ride-sharing apps, or online marketplaces is no longer small-side money. It's fully traceable, permanently recorded, and increasingly audited. What's alarming is how the system works. Platforms are now required to share income data directly with tax authorities. That means the CRA doesn't need to guess. They already know how much came in. If your reported income doesn't match their records, it can trigger retroactive audits, penalties, and interest going back years. Even people who earned casually or part-time are being caught off guard. The biggest danger isn't tax itself, it's misunderstanding. Many creators and gig workers don't know what counts as taxable income, what expenses are deductible, or when registration is required. One wrong assumption can turn a side hustle into a financial nightmare. And once an audit starts, stress, paperwork, and costs spiral quickly. Protection starts with clarity. Track every dollar earned online. Separate personal and business accounts. Learn what needs to be declared and when. The goal isn't fear, it's control. Because in the digital economy, invisibility no longer exists. Tell us in the comments, do you earn money online even as a side hustle? We put serious effort into uncovering these silent traps, so please support the channel by subscribing. It's just one click, and it helps us keep you informed and protected. Number 5, exit tax trap. Many Canadians believe that if things get too expensive, they can simply leave the country and start fresh somewhere else. But what most people don't realize is that Canada has a powerful weapon waiting at the exit door, the departure tax. The moment you officially cut residential ties, the government can treat many of your assets as if they were sold on the same day, even if you never sold anything. This means unrealized gains on investments, businesses, stocks, and even certain foreign properties can suddenly become taxable all at once. People are shocked to learn they owe massive tax bills after leaving, sometimes months or years later. It feels like freedom on the outside, but financially, the system still has its grip on you. The danger increases if you own foreign property, overseas bank accounts, or investments outside Canada. Reporting rules are strict, complex, and unforgiving. Miss a disclosure, misunderstand residency status, or file incorrectly, and penalties can pile up fast. Some Canadians are hit with fines so large they're forced to liquidate assets just to pay taxes on money they never actually received. What makes this worse is timing. If you don't plan properly, leaving too late or leaving the wrong way can permanently damage your finances. But with the right preparation, legal structuring, and professional advice, many of these costs can be reduced or avoided. The key is planning before the move, not after. This isn't about fear. It's about understanding the rules before they're used against you. Leaving Canada without a plan can be one of the most expensive mistakes of your life. Let us know in the comments. Have you ever thought about leaving Canada for good? We put real time and research into these videos, so please support the channel by subscribing. It's just one click, but it helps us keep protecting you. Number 6. Savings Account Squeeze. Most Canadians believe their TFSA and RRSP accounts are safe havens, protected, tax-advantaged, and designed to help them build wealth peacefully over time. But recent enforcement changes are turning these trusted accounts into potential audit triggers if you're not careful. The rules haven't just tightened, they're being enforced more aggressively than ever before. Here's the issue. If the CRA believes you're using your TFSA for what they classify as business activity, such as frequent trading, day trading patterns, or sophisticated investment strategies, they can reclassify your gains as taxable income. That means profits you thought were tax-free could suddenly be taxed heavily, plus interest and penalties. Many investors don't even realize they've crossed that invisible line until a letter arrives. RRSPs carry their own risks. Early withdrawals, incorrect contribution calculations, or over-contributions can trigger unexpected taxes and compounding penalties. And with markets fluctuating more than ever, small mistakes can quickly become expensive ones. The real danger isn't breaking the rules intentionally, it's misunderstanding them. The safest move right now is discipline. Track contributions carefully. Avoid excessive trading inside registered accounts. Keep detailed records of every transaction. And if your portfolio has grown significantly, consider getting professional advice before making major changes. These accounts are meant to protect your future, but only if used correctly. Be honest in the comments. Do you actively trade inside your TFSA or RRSP? We spend serious hours researching these financial traps, so please support the channel by subscribing. It's just one click, but it helps us continue protecting your hard-earned money. Number 7. Inheritance tax pressure. Most families believe that whatever they leave behind will help the next generation build a better life. But new and expanding estate and inheritance tax pressures are quietly turning that dream into a financial shock. In Canada, there may not be a formal inheritance tax, but when someone passes away, the government treats it as if everything was sold on the day of death, and that can trigger massive tax consequences. This is where families get blindsided. Capital gains on homes, cottages, investments, and small businesses all become taxable at once. Heirs often assume they can keep the family property, but instead they're hit with a tax bill so large that selling assets becomes the only option. Family homes that were meant to stay in the bloodline for generations are being sold simply to pay taxes. The situation is even worse for small business owners and farmers. A lifetime of work can disappear in months if proper planning wasn't done. And because these taxes arrive during moments of grief, many families make rushed decisions that cost them even more money in the long run. The painful truth is that doing nothing is a decision, and it's usually the most expensive one. Basic estate planning, clear records, and early conversations can drastically reduce the damage. Yet most people delay it, assuming they have more time. Often they don't. Inheritance isn't just about money. It's about legacy. Without preparation, that legacy can be quietly dismantled by taxes and forced sales. Tell us in the comments. Have you ever talked about estate planning with your family? We put deep research and real effort into these videos, so please support the channel by subscribing. It's just one click, but it helps us keep educating and protecting families like yours. Number 8. Small Business Stranglehold. Small businesses are the backbone of Canada's economy, but new tax and compliance rules are slowly choking them from every side. Rising payroll taxes, stricter reporting requirements, and increased audit pressure mean that running a small business is no longer just about making sales. It's about surviving paperwork, penalties, and constant financial stress. What many owners don't realize is how fast costs are stacking up. Employer contributions for CPP, EI, and other mandatory programs continue to rise, even when profits don't. add compliance software, accountants, and legal fees, and suddenly a profitable business starts bleeding cash. For many entrepreneurs, taxes are now one of the largest operating expenses, not rent or inventory. The real danger is enforcement. Small businesses are easier to audit than large corporations, and mistakes, often unintentional, are punished harshly. Late filings, payroll errors, or misclassified workers can trigger fines that snowball quickly. Some owners discover problems years later, when penalties and interest have already doubled the damage. This pressure forces painful decisions, cutting staff, raising prices, or shutting down entirely. Thousands of businesses close not because they failed in the market, but because the system became too heavy to carry. There are still ways to protect yourself: restructuring operations, understanding deductions, and staying proactive with compliance. But waiting until you're in trouble usually means you've already lost leverage. Running a business shouldn't feel like walking through a legal minefield, but for many Canadians, that's exactly what it's become. In the comments, tell us, do you own or work for a small business feeling this pressure? We invest serious time into researching these issues, so please support the channel by subscribing. It's just one click, and it helps us keep standing up for everyday business owners. Number 9. AI Audit Surge. Canada's tax system has entered a new era, one powered by artificial intelligence. The CRA is now using advanced data matching systems to compare bank records, platform income, property sales, and filings in ways that were impossible just a few years ago. This means audits are no longer random. They're targeted, automated, and relentless. Here's what makes this especially dangerous. The system doesn't look at context first. It looks at patterns. If your income, expenses, or transactions don't match what their algorithms expect, you can be flagged even if you did nothing wrong. Honest taxpayers are receiving audit letters simply because their financial behavior looks unusual to a machine. Once flagged, the burden shifts to you. You must prove everything: receipts, records, timelines, sometimes going back many years. If anything is missing, penalties and reassessments follow. And because interest compounds, even small discrepancies can explode into massive liabilities. This affects everyone: employees with side income, seniors drawing from multiple accounts, families whose sole property, digital earners. The days of flying under the radar are over. Every transaction leaves a footprint, and the system never forgets. The best defense is preparation. Keep clean records. File accurately. Avoid shortcuts. Transparency isn't optional anymore, it's survival. Understanding how these systems work can be the difference between peace of mind and years of financial stress. This isn't about fear, it's about reality. The tax authority now moves faster than humans ever could. Tell us honestly in the comments. Have you ever been audited or worried about one? We put countless hours into researching these changes, so please support the channel by subscribing. It's just one click, but it helps us keep you informed and protected. Number 10. Inflation Tax Trap. This is the most dangerous tax of all, because it's never voted on, never announced, and never explained. Inflation acts like a silent tax that drains your money every single day. While official taxes show up on paper, inflation quietly destroys your purchasing power, making your savings worth less year after year without you doing anything wrong. Here's the brutal reality. If your income isn't rising faster than inflation, you're effectively getting poorer. Cash sitting in bank accounts loses value. Fixed pensions shrink in real terms. Even modest savings plans fall behind. What makes this worse is that inflation compounds over time, meaning the longer it lasts, the harder it becomes to recover. Many Canadians won't realize the damage until retirement, when it's already irreversible. This hits seniors and middle-class families the hardest. People who did everything right, saved money, avoided debt, planned carefully, are watching their financial security erode. Groceries cost more. Utilities rise. Insurance jumps. But wages and benefits lag behind. That gap? That's the inflation tax taking its cut. The most painful part is psychological. Inflation creates the illusion that you're stable because your bank balance hasn't dropped dramatically. But in reality, that money buys less every month. Doing nothing is the worst possible response. Defensive planning, understanding where your money sits, reducing exposure to pure cash, and staying informed is no longer optional. It's survival. This final law ties all the others together. Higher taxes, higher costs, tighter enforcement. Inflation amplifies every single one of them. Ignore it, and it will quietly finish the job the other laws started. In the comments, tell us the truth. Do you feel like your money doesn't go as far as it used to? We put serious effort into exposing these hidden threats. So please subscribe to support the channel. It's just one click, but it helps us keep protecting people like you. As you've just seen, none of these changes exist in isolation. Each one may seem manageable on its own, but together they create a financial pressure system that quietly tightens year after year. Higher taxes, stricter enforcement, rising costs, and shrinking purchasing power all move in the same direction. The result is a reality where doing nothing becomes the most dangerous decision of all. Many Canadians won't feel the full impact immediately, but by the time it becomes obvious, the options are fewer, the costs are higher, and the damage is often permanent. What makes this moment so critical is timing. Before April 2026, there is still room to plan, adjust, and protect yourself. Awareness gives you leverage. Understanding the rules gives you choices. Whether it's reviewing how your assets are structured, how your income is reported, or how your savings are positioned, small steps taken early can prevent massive losses later. This isn't about panic. It's about preparation in a system that rewards those who act early and punishes those who wait. The truth is, many hardworking people are being pushed into financial stress not because they failed, but because the rules changed faster than they were told. And that's why conversations like this matter. Silence benefits the system. Information protects people. The goal of this video isn't fear, it's clarity. When you see the full picture, you can make smarter decisions for yourself and your family. If this video helped you understand what's really happening, don't keep it to yourself. Share it with someone who needs to see it. Leave a comment with your thoughts or experiences. Your voice matters here. And if you want to stay informed as these changes continue, support the channel by subscribing. It's just one click, but it helps us keep doing the research, asking the hard questions, and protecting people like you.